I'm Rich Nuzum. I'm the head of the Outsourced Chief Investment Officer business at Franklin Templeton. I've been giving institutional asset owners strategic advice and helping them with implementation for more than 35 years. And I look forward to talking with you.
You attended the Milken conference this past week. What did you learn from the conversations you had with asset owners around the conference, which you didn't know previously?
A lot of micro learnings that we might get into, but the big themes were confidence and resilience. I was really shocked and surprised at how confident the participants were about the future, AI and digitalization. While there's concern around the conflict around Iran, optimism in terms of how the global economy will get through that, and then just resilience of portfolios, resilience of risk tolerance. So confidence around the world and a focus on making portfolios and businesses resilient to navigate through that.
How has the Iran conflict, including the disruption to shipping through the Strait of Hormuz, changed the economic and capital markets outlook? What are the asset owners doing in response to this?
It's really changed the near-term outlook from one where when we entered the year, there was consensus that the Federal Reserve and other central banks globally would be cutting short-term interest rates, and that would push investors out of cash into risk-bearing asset classes. So a focus on diversification, but with a sense that the yield curve would steepen and that the markets would broaden in terms of participation. With the conflict, we've had a stagflationary shock. And so at the short end of the curve, the Fed and other monetary authorities now need to keep rates up to fight off inflation, first from the energy and food price shock from the conflict, and then second from the fiscal stimulus that governments are making to counter the anti-growth impacts of the conflict. So two different inflation shocks or a double whammy on inflation. So with that, we see investors still really emphasizing diversification in their portfolios, this idea of broadening out how they participate in the global economy, but also trying to get inflation hedging into their portfolios more strongly. And that's creating a lot of demand for infrastructure investment, both equity and debt, and also demand for forms of private credit that roll over faster and provide some longer term inflation protection also.
There is a perception that geopolitical risks have become more and more prominent over the past few years. How are the asset owners incorporating geopolitical risk management into their investment practices?
I think there's two ways. One, echoing the conversation that we just had, there's a growing realization that geopolitical shocks often represent themselves economically as a stagflationary shock, meaning prices go up and growth goes down. And so that emphasis on diversification, inflation hedging is part of how asset owners are trying to hedge against further geopolitical shocks. If you think back to Liberation Day, the Russian invasion of Ukraine, the geopolitical shocks we've had have generally been flowing through the capital markets as a stagflationary shock. The other approach is to have an opportunistic bucket or a dynamic bucket in the strategic asset allocation, where investors are often holding physical cash, using futures or swaps to effectively equitize that cash into a global index exposure, whether that's equity or fixed income, with the idea that when we hit a crisis, if they're not disrupted in their core business, they can be an opportunistic buyer of things that other people have to sell at a discount. If they are disrupted in their core business or economy, they have that physical cash that they can use to meet a liquidity shock. So that holding of dry powder, not in cash and suffering opportunity costs of losing ongoing yield, losing ongoing return, but cash that's equitized into the markets and yet still available for deployment quickly in the event of a crisis. I think that's the other major response we're seeing to concerns about geopolitics.
And shifting the conversation a little bit from geopolitical conflicts, you've been involved with central bank reserve management practices dating back to the Asian financial crisis, and you recently participated in a major global conference for central banks. Over the past few decades, central banks as a group have, on average, reduce their holdings of US dollars and increase their holdings of gold. So how are central banks viewing gold and the US dollar at this point? And how do you expect to see central bank reserve management evolve going forward?
From the Asian financial crisis, central banks have been concerned about safety, liquidity, transparency, and more recently about domicile risk. That is, where their assets are held and are their assets subject to sanction if their state gets into a conflict with other national actors. And gold has risen to about 18% of central bank reserves on average after having a long sort of 70-year decline. That's really concern about the US dollar and whether the US government at some point may have issues repaying its debt as the U.S. continues to run fiscal budget deficits at 6 or 7% of GDP. But the U.S. remains the least dirty shirt in the laundry is the common metaphor. You wake up, you need to go to class, you need a shirt, all your shirts are in the laundry basket, you take the least dirty one. The euro, the yen, sterling, renminbi, there's no other currency that's freely convertible, liquid. The US dollar is still the major reserve currency, but gold is making a comeback, not just at the expense of the US dollar, but at the expense of all the other currencies. Some of the cons to gold, so gold's had great returns over the last 5 years. It's no longer behaving as a safe haven asset in the short term. The gold prices have dropped with the Iran conflict, which is a bit counter to historical experience with gold. Now they dropped from a historical high, and everybody holding gold is generally still sitting on unrealized gains because gold ran up so strongly before it dropped, but not quite behaving as a safe haven asset anymore. And then the opportunity cost of holding gold is high. If the 10-year treasury is going to give you 4.4% as of our conversation today, well, you're paying storage costs for gold plus sacrificing that yield. The last thing that's happening with gold goes back to this domicile risk. If you hold your gold with the Federal Reserve Bank in the US or with the Bank of England, and those governments elect to sanction your country, then your gold reserves are frozen. So you no longer have a liquid safe asset. But holding gold in your country means the gold's not liquid. If you're holding it in your own vault, you can't quickly sell it to anybody else in the event of a crisis. So that's a kind of hard, real-world physical trade-off that central banks are dealing with in practice.
Something that you touched on at the very beginning of the interview. So one mega trend impacting the real economy and capital markets, with new announcements seemingly every day, is the AI and digitalization boom. So in your opinion, is this a bubble, or are you comfortable with the amount being invested in this megatrend?
I'm not comfortable with it, but probably in the opposite direction of what you would think. As you mentioned, attended the Milken Summit. And one thing that happens at Milken is a lot of entrepreneurs are looking for capital to fund their ventures. And larger companies, both investment managers and real world economic players, are talking about, in this case, what they're doing with AI and digitalization. And I believe that as a global society, as an economy, we're still underinvesting in AI and digitalization, and not just in terms of the hard cost of what's being spent on chips and data centers and power generation, but the bigger issue is the soft cost of companies coming to grips with, how do I use this to augment the performance of my human employees? How do I help my employees compete with AI? And I don't mean compete against AI. I mean use AI to compete against our competitors as an enterprise. And that soft cost of training people, I'm sure you experienced in your life, trying to keep up with what AI can do for me in my work. It's really exciting. It's also really challenging. And I've got some colleagues that are better at it than I am, and I'm asking them to tutor me, and you have to be humble and you have to ask for help. And, it's a challenge to just keep up with the productivity improvements that you can get from AI. I mentioned optimism earlier in regards to Milken. There was a very strong consensus that AI is going to drive employment growth, including for what we often call blue-collar workers, but less educated workers that have had difficulty participating in the economy, because AI makes people expert so quickly. It augments their performance. You don't have to do a job for 10 years to be a master of detail. If you don't know something, you can ask the AI, it gives you the answer, you go on with your day. And then the robots still can't do things. Classically, there's no robot that can load and unload a dishwasher yet without breaking plates. We still need human beings, not just for that, but for the EQ, for the relationships. AI is augmenting us, it's not replacing us.
They say, you're not going to be replaced by AI, but rather by somebody that knows how to use AI.
I think that's exactly right. And that's true at an individual level. It's also true for companies. It's true for investment managers. The pace of innovation is picking up. Yesterday was the slowest day of change we'll experience in the rest of our lives. And on the one hand, that's psychologically challenging for people and organizations. How do you get your employee base comfortable with constant change? And your job as you do it today may not exist in 3 years, but there will be another job that you can do for us. And your human capital with this organization, your reputation, your relationships, that's all valuable to us. but then you have to use AI more effectively every day, or you will fall behind.
And shifting to liquidity, there is a lot of innovation happening around liquidity management for institutional asset owners, allocating to private market asset classes. What are some of the best practices you see evolving in this area?
So we see institutional asset owners doing three things. One is making use of semi-liquid evergreen fund structures. We may think of those as having been created for retail investors and part of democratization of private markets, but institutional investors that have been very comfortable with closed-end funds and drawdown vehicles, they look at those and say, well, if the liquidity doesn't hold up, then I'm holding the underlying and I'm fine with that. If the liquidity holds up, if the fund's not gated, then I have liquidity when I may need it and nobody else does. And that's better than going to the secondary markets with closed end. So not every investor is doing that, but some use at the margin of semi-liquid evergreen structures, either to get in more quickly or to opportunistic rebalance. The second innovation is maturation of the secondary markets, experimentation with tokenization, where it used to be the case 10 years ago that a CIO couldn't go to their investment committee and say, hey, I want to sell this fund interest we have at 85 cents on NAV, because the committee would say, well, what about the other 15 cents? We should just hold it and get the full NAV. Now they'll go to them and say, I want to sell it at 85 cents on the NAV because we're going to redeploy that money into other investments that have a higher forward-looking IRR. And committees are getting used to that opportunistic use of the secondary markets for rebalancing. That's making it more liquid on the seller side, and on the buyer side, that's offering good ways to get into passive vintage years, diversified portfolios. So it's helping both sides of the equation with a more liquid market, even though it's not exchange traded, not fully liquid. The third thing we've already talked about in regards to being opportunistic or ready for a geopolitical shock, but it's this idea of barbelling your liquidity management. So you have your private market allocations that are liquid, and then you have physical cash. You equitize it with futures or swaps to get the equivalent of a passive index fund exposure, equity or bond. And then if you need liquidity for any reason, you've got it. And you can be a buyer when everybody else sells, or at least you can stay the course if you have a liquidity shock in your business, your net cash flows go down, but you still need to meet capital calls and other deployments. So that barbelling of liquidity, that equitized cash approach is becoming more popular. And for organizations that can borrow in the physical capital markets, think about a not-for-profit hospital, a school, a corporate business, even a sovereign wealth fund. We see more and more organizations borrowing in the physical capital markets to have additional cash in the portfolio, investing that cash to try to at least repay the cost of that debt or get pretty close to it. But then when a crisis hits, they have physical cash. And in a crisis, you're not going to be able to borrow in the physical capital markets. So doing that ahead of time when life is good and the markets are stable, we think is really smart if you're in an organization that can possibly do that.
What are you excited about regarding tokenization and digital assets?
I'm excited about the liquidity improvement for my client base, and then the access for investors, including smaller investors. In some markets, especially the US, it's been hard for retail investors. It's been hard for defined contribution participants to access the private markets. So to the extent that we're making progress in making those investment opportunities, that diversification opportunity, that long-term return potential available to individual investors through tokenization, I think that's really great. And there's not complete overlap between the digital assets ecosystem and digitalization, AI as an economic theme in the broader economy. But some of the most innovative players, some of the most innovative applications do overlap. So to the extent we're innovating on technology because of financial services applications for digital, because of digital assets, that will sprinkle into the real economy. And I'm bullish about the real economy anyway. Just the wall of money being aimed at venture capital, the way that corporations are getting better about seizing innovation and accepting that they either innovate or their C-suite will be out of a job. I think that's good for driving progress forward and making all of us more productive and having resources to pay off our debts and help people get educated and pay for healthcare and so on. So I'm very optimistic about digital AI. If you wanted to talk in a lot more granular detail about digital assets and tokenization, I have a colleague, Max Gochman, who's full-time on that for our investment solutions business, just lives 24/7, almost literally in that space. He could give you many examples of where we're seeing application of new things already that's making the capital markets function better.
Thank you so much for your time. Really appreciate our conversation.
Thanks. I've enjoyed talking with you.